So welcome. This is Stacy Francis of Francis Financial. We're going to be talking about the first quarter market review as well as some of the things we need to be looking out for as we move forward for a really interesting year so far. I think the word interesting everyone will agree with. As far as the year so far, it's been one of the most volatile years with the stock market. And so I don't know about you, but all I can say is it's been quite an Alka-Seltzer-induced year, and we expect it to continue as well going forward. So what do you need to think about? What is important for you to be focusing on? We're going to be spending some time today going through all of these pieces. But let me give you a little bit of background before we jump into this. We're hoping to get through this in about 45 minutes. You can forward to certain sections if you want and go back and listen to other sections. But know that definitely make sure that you have your pen and paper ready because we're going to be going through a lot of information. So Francis Financial, we are a fee-only fiduciary investment firm. We are here and really working with clients to help them understand everything they need to know about their financial situation. And that means financial planning out until age 95, helping with estate planning, tax planning, education planning, such as college and private school, which can be very expensive. I actually just enrolled my son in private school, so I am living and breathing that right now. But then also understanding what to do with their investment portfolio. And what we've heard from many people, very smart people too, is that the investment portfolio portion of their finances is the area where they're most intimidated, have the least amount of time to really stay on top of, and where we feel like we can give great value add. So that's what we're going to be talking about today. We're going to be talking about a couple different areas, and in particular, let me just move forward to this next section, specifically our agenda. So we're going to go over what happened this last quarter, what do we expect going forward, what are the choppy waters? Why are they considered choppy waters now with what's going on in the market? How far in the future do we expect this similar behavior from the markets? And then two really important pieces to end on. Number one, how to not make the biggest money mistakes that we see. And they're not only money mistakes that we at Francis Financial have seen with outside individuals who are not our clients, but on top of it, CNBC, Motley Fool, Kiplinger's, Money Magazine also agree that these are some of these top mistakes that they see over and over again that really unfortunately impact your financial security, making it much harder to get to that end goal of being able to retire and know that your money is going to be there for the rest of your life to support you. And then our second opinion service. And this is one of my favorite parts because if you know of any friends or family that would like a second opinion about what they are doing with their financial plan, about what is going on with their portfolio, understanding maybe what is really what is in their portfolio, it's a great free benefit that we offer. And I'll actually take you through a sample second opinion too, so that you can take a look at that. So let's jump right into the market review. I want to make sure that this is nonstop information and that we use your time wisely. Well, it was quite a year. In fact, you can see here that there were numerous headlines just in the first quarter. And unfortunately, a lot of these headlines, and you can even see them right now, stir a lot of anxiety, even in the most hardy and seasoned of investors. And that truly was the case this last quarter. In fact, we've had an interesting quarter. You can see with too many headlines, there was an unfortunate impact on the market. In fact, almost all major indices were down. You can see the U.S. stock market for the last quarter, that first quarter was down almost 1%. Developed international stocks were down more than 2%. The U.S. bond market was down about 1.5%. The biggest bright spot that we saw were the emerging market stocks. And the positive for many, and in fact, most of our clients, is that we are overweighted in their portfolios specifically in emerging market stocks. We have a couple clients that have less than we would ideally like, mostly because their own personal fear about that part of the world. But for 99% of our clients, we are overweighted there. And so despite all of the indices being down during these last 3 months, January, February, and March, all of our portfolios were actually positive so far for 2018. So we're very proud and very happy about that. U.S. stocks, as we said, were down, but if you go into what happened on a month-to-month basis, you can see that U.S. stocks actually did quite well in January. And it was towards the end of January that we started to see that anxiety, the panic attack in the market, where we saw the large dip. And since then, you've seen here what we are technically calling choppy waters. Choppy waters here for U.S. stocks. And you can see that as where they started here and where they ended, we actually, again, as I mentioned, ended the quarter a little bit down. Volatility has definitely returned. In fact, I love this cartoon. This cartoon, I feel like, is the perfect example of what's going on, and that we're seeing the ups and downs, and it's something that is going to continue. What about volatility? When have we seen the most volatility? When have we seen the least amount of volatility? So we went all the way back to 1950, and so I apologize, this is a pretty big chart here. We went, as I mentioned, all the way back to 1950, and we looked at, in the dark blue, the number of days that had increases in the market by more than 1%. And then in the light blue, showing decreases in the market greater than 1%. And you can see in 1950 we had quite a interesting and volatile year. Also, you can see here in the mid-70s, not surprising. You can see also a lot of volatility in 2008, right up here. And there are some years also where we saw a lot of essentially calm waters. And here is one of those calm water time periods in the mid-1960s. It was actually the all-time low volatility, 1964. And another all-time high, though, was 2008. We also have 2017. Now, look at 2017. Very calm waters, not a huge amount of volatility, just actually a little bit more than what we saw of the all-time low in 1964. And then we have the first quarter. Look at this, the first quarter. This is only 3 months. We've got 9 months to go, and you can see how volatile and how many days we had where the market went up for more than 1% and the market went down more than 1%. What do all these numbers mean? Well, it means that after last year, where we had such calm waters, very little ups, very little downs in the stock market, this year, well, it's a remarked difference. And if anything, it's part of the reason why this volatility that we're seeing is feeling so severe. So we've just talked a little bit about the U.S. stock market. The next thing I want to do is take a little look into international. So international, we have 2 different segments. We have emerging markets. So all the emerging markets we went through, and we circled those in green. Emerging markets are exactly what they sound like. Countries whose economies are emerging, often their economies are also growing at a much faster pace than the developed markets. Now, something you'll see among most of these emerging markets is that they did fairly well. Brazil, one of the all-star outshiners for the first quarter, had a 12.5% return. And then we have developed international. Developed international, as we mentioned, was down for the quarter. And you can see that the UK was down about 4%, Spain down as well, Hong Kong down as well. And in Australia was one of the bigger laggers, as well as well as Canada here. So this gives you an idea of what's happening on an international basis. So one of the positives, as I mentioned, is that we've got an overweighting to emerging markets, so we really did benefit from this increased performance that we saw specifically from that area. So what does this really mean for you? Well, Poland, I want to tell you, is considered an emerging market. During the fourth quarter of the year in 2017, it was actually one of the top performers. It was one of the top performers. However, on the next slide I'm going to show you, interestingly enough, it was one of the worst performers this year. So what does this mean? It means that for diversification, you don't want to put all your eggs in one basket. And so just because Poland did so well last quarter does not mean that you want to put all your money there. And what we're seeing and what we've done over these last few years is we've taken money in more developed markets, such as the UK, particularly in the US, and we've moved that money into these countries here, as you would describe them as emerging markets. Most of the money that we have taken to fund our emerging market exposure is actually from U.S. stocks. And the reasoning for that was because we have seen over the last few years that the price of U.S. stocks, that they become relatively expensive. They've become relatively expensive compared to the types of returns we expect from U.S. stocks over the next 5 years. Remember that chart I wanted to show you? Well, here we are, Poland, in the fourth quarter of 2017, a 52% return. Really phenomenal in 3 months. Wow. But you can see, how did Poland do this first quarter? Not so great. So really, again, what this is saying is that putting all your money in one basket is not the right thing to do. When you're investing in any part of the world, especially in emerging markets, you want broad exposure. You want exposure to many different countries that make up that part of the world. So let's talk a little bit about bonds. And boy, there's a lot going on with bonds. In fact, Janet Yellen was replaced with Jerome Powell. Lots of uncertainty, but what I think the one piece that we can all agree on, and that Jerome has made it very clear, is that he will be pushing interest rates higher. Pushing interest rates higher. And what does that mean for you? What does that mean for your bonds? Well, when interest rates go down, like we saw after 2008, bond prices go up. Now we're in a different situation. We're seeing interest rates go up. And because of that, we will expect bond prices to go down. A fancy way of saying that it's going to be harder to make money on bonds. Now, there are some positives, and this is really important. Interest rates go up. It means that the interest rate on newly issued bonds will be higher. Just like you may have noticed on TV or even in print ads, that the interest rate being offered on savings accounts at Capital One, at Chase, some of those other banks have gone up too. So that's a positive. That's definitely a positive. Just as the interest on those savings accounts, even on certificates of deposits, CDs have gone up, it means that new bonds that will be issued, they'll be issued at higher interest rates. But it means that the bonds you hold right now, well, the bonds you hold right now, doesn't make it so interesting. In fact, I put a little unfortunate frowning face there, because it means that if you have a bond that's paying, let's say, 2% interest for a 20-year investment grade, which means very high credit quality, very secure bond, and a new bond is being issued with the exact same characteristics, 20-year high investment grade, maybe even the same company. Let's say it was a GE, General Electric. Now they might be issuing it, giving offer 3%. Well, what does that mean for your bond? Well, it means that your bond is not as exciting for people to purchase. It means that the price of your bond most likely is going to go down. So that's what interest rates mean. And it also makes it really imperative to understand the types of bonds you have, because some types of bonds have much more changes in their value based on interest rates than others. And so for us to protect against interest rates going up, what we're doing is we're investing in what's called shorter term bonds. They're bonds that mature in 1, 2, or 3 years, and they are the most protected, the most insulated from interest rates going up. And we made that change over the last 6 months, knowing full well that interest rates were expecting to rise. So let's talk about going forward. We've looked at the going backwards. Now we're going to look at what's going to be happening in the world, both the United States, international developed countries, and emerging markets over the next several years. And when we say next several years, we typically look out over a 5-year time horizon. So one of the best ways to understand what's going to happen in the future is, again, to look backwards. And here we have U.S. stocks. And U.S. stocks, you can see, going back from March 2008. March 2008 was the agreed upon drop from there, where we started to see the biggest losses in the U.S. stock market. And you can see where the recovery started to occur in March 2009. And you can see that this recovery has continued over time to where we are. Now, what's important here is to then look at comparison, for example, between that and historically what the value or the price to earnings of U.S. stocks have been. What this tells us, this gray shaded line, is that historically this is the 10-year average of price to earnings, which is a measure of how expensive U.S. stocks are. We can see that here, and look at this. Look where we are trading today. So are we more expensive than we are historically, or are we less expensive? Well, the plain vanilla answer is that we're more expensive than we have been historically for many, many, many years. It doesn't mean that we pull all our money out of U.S. stocks, because that would be foolhardy. And that's one of the big mistakes that investors make, is that they take their money and they pull out completely from a certain area of the market. But what it does mean is it goes and it gives you information. And what that information is that you need to make sure that your portfolio has both international developed as well as emerging markets. 30 years ago, you often would see a portfolio with all U.S. stocks, but today it's not something you see very often. And every once in a while, we'll have a potential client come in for a second opinion, and we will see that 99% of their stocks are U.S. stocks. And unfortunately, they are really underexposed to some other areas of the market, and really, unfortunately, are putting all their eggs in one basket, the basket of U.S. stocks, which, again, we typically are going to be talking about throughout this whole presentation that the types of returns we expect over the next 5 years from U.S. stocks are going to be nowhere near as significant or large that we've seen over the last 5 years. So U.S. stocks compared to the other parts of the market, you can see this is U.S. stocks right here. Then we added in international developed, and then right below it, emerging markets. Really powerful to be able to see how the valuations are internationally relative to the U.S. And you can see that while emerging markets have done well, they're still nowhere near as expensive as U.S. stocks. The same thing with international. While international stocks have done well, they're nowhere near as expensive as U.S. stocks. So we're excited about the prospects, particularly of international developed markets as well as emerging markets over the next 5 years. Those two pieces are really the true engine that is going to be boosting up your portfolio, that's going to help their lagging U.S. stocks over these next 5 years. So as we've looked forward, I also want you to understand a little bit about that volatility that we talked about just a few minutes ago. So my question to you is, how would it feel to know with absolute certainty that you're going to have financial security for the rest of your life? Imagine that you had a SWAT team of 4 security officers that at all time the SWAT team is protecting you, protecting all your money to make sure that you have financial security for the rest of your life. Well, you can. And you can have pure confidence, unwavering confidence, no matter what is happening in the market. And the best way of doing that is having an all-weather portfolio. And I love this chart here, this picture, because to be honest, I didn't even realize that there were really all these different options of weather, between the, cloudy and overcast to the heavy rain. Imagine a portfolio that can stand up in all of these different, unique weather systems. And that's really what you need to do. Because what we want to make sure that we're focusing on is we want to focus on the things we can control. The ups and downs of the market, it's here to stay. In fact, in order for you to do well in the market, you have to be able to deal with risk. You have to be able to and be willing to accept that your portfolio is going to be up some days and it's going to be down. And one of the best ways to have that comfort and security is to control the things that you can control. And that is letting the market do its work for you, being smart, and investing like we invest for our clients in a really tax-efficient way, making sure that the dollars that they do earn in the portfolio are in the least tax-impacted as possible, so that they walk away with more money than they might expect. Making sure that the way that you're investing is low cost. And I think about this as when I go to Pottery Barn and they in the front put all of the new items for that season. But if you go in the back of Pottery Barn, you see all these amazing, wonderful things that are on sale. So making sure that you are getting great quality investments, but not having to pay too much. Diversifying, which we've talked about significantly over our call that we've had here today, and also making sure that we're staying disciplined. So from that, we're going to go into what are those biggest investment mistakes. And the number one biggest investment mistake, drum roll, moving to cash. Moving to cash. I see far too many individuals getting spooked and moving to cash. And what I liken it, moving to cash, it's like hitting a pothole and then swerving after. You don't fix the damage. Guess what? The damage is always already done. And what happens if you swerve after a pothole? Well, you can see very clearly what happens. You end up getting in a car accident. And this is a really interesting chart here. You can see that after the September 2001 terrorist attack, 1 year after, you would have still been down 1%. But you can see that 3 years after, you would have had a 40% return. Keeping your money invested during the 5 years after that unbelievably awful event, your money would have grown 81%. It's also the same with the 2008 happening in the market. 1 year later, you would have been up 4%. 3 years later, you would have been up 12%. 5 years later, you would have had nearly a 50% return. So really, what this is saying is don't move to cash. Any of the people who moved to cash after either of these catastrophic events never recovered. In fact, it was so sad. A lovely woman came to us about a month ago. We did a second opinion for her, looked at all of her portfolio, and a good amount of it was in cash. When we asked her why so much, she said that she just couldn't ever get back in with that, and that she had moved to cash right after March 2008, which we knew was essentially a low point, and she slowly from March 2008 through the end of that year turned more and more of her long-term investments in retirement into cash and never, ever reinvested it. So those massive losses that she sustained in her retirement in 2008, she never, ever recovered. So a really big lesson. So let's talk about the second biggest investment mistake. And I love cartoons. I feel like there's not enough cartoons. And this cartoon says it all. A little boy asking his dad, how exactly does the stock market work? And he says, well, put your money into it, and for some reason, you lose money. And then you panic. You sell. And you sell to someone who's smarter than you and makes your money instead. So really what this is essentially a cartoon saying that the worst thing you can do is to sell when the value of your stocks go down, because someone who's smarter than you is going to purchase them, and they're going to make your money for you. In fact, a wonderful quote from the Chicago Booth School of Business, and that we believe as well, that market timing does not work. The way to invest is using emotion-free, using proven investment formulas. And if you take out the emotion from your investment decisions, from your investment process, you can invest confidently, knowing that each decision you make is not based on concern or worry, fear or greed, but it's based and it's rooted on academic research. And we are one of those companies. We work with Dimensional Fund Advisors, also another amazing research house, Lippman Gregory, where all of the decisions we are making are really academically based. Really important to make sure that we're making decisions not by fear, concern, but by long-term sound investment decisions. So why doesn't market timing work? Well, we know that the market's irrational. Some days it might be up, some days it might be down. It tends to act very irrationally, often based on what's going on in the news. You definitely can't predict it. If you can predict the market, that would be great to know, but we have not yet found anyone that can do that with significant success over the long term. And often our strongest emotions to buy in the market or sell are typically wrong. And a good example is Bitcoin. The number of people who wanted to buy Bitcoin when it was trading at 17,000, it was a huge swelling of number of queries that we got from both reporters that were interested because their readers wanted to know more about how to get in on the action, and even some of our clients wanted to buy into Bitcoin. And we found that often is the worst time to buy because it's trading at a high. It's the FOMO issue. In fact, FOMO is something I've learned that millennials talk about. It's the fear of missing out. The fear of missing out on that next hot stock, that next hot investment. In selling, often our urge to sell is when we've seen the price of that stock or that investment become decimated. And that's typically the worst time to buy. So again, market timing is not the best because our urges to buy and sell are typically at the wrong time. So our third biggest investment mistake is essentially making the mistake of paying high fees and high taxes on our investments. In fact, what you want, right? You want low cost. We want low taxes. And I have to tell you, fees and taxes do matter. Here is an example. So in a retirement account, you can see that we have the expense ratio of 0.9, transaction costs of 1.44, and cash drag. That means leaving some money in cash. So what is the total cost? About 3.17%. Well, in a non-retirement account, if you're not smart about how you are managing the taxes, look at that. Your total cost went up a whole 1%. So being smart about how you're investing non-retirement accounts and making sure that the most tax-efficient investments are in those non-retirement accounts. Why does it matter? Well, it matters a lot. In fact, an actively managed fund, so this is talking about fees, an actively managed mutual fund can charge you I've seen up to 3% a year. So take whatever you earned and take off 3%. That is pretty darn expensive. Now, an index fund, a less expensive index fund, and some of our funds are right within there, so 0.05%. You can see that actively managed fund is 60 times more expensive. So to figure this out from like a cappuccino perspective, which is how I kind of live my life. In fact, I have a cappuccino right here next to me. So it's similar to paying, in one example, let's say you go into Starbucks with your friend, and your friend goes and buys that really nice cappuccino. Now she pays $4.15. Well, you go and guess what? You're shocked because that same cappuccino is 60 times more expensive. You're having to pay $249, and you can see this woman shocked. Well, I would be shocked too. But it's very apparent when you see paying a cappuccino, but know that expense differential occurs every single day in people's portfolio around the world. And why does this matter? Well, it means that you're going to have less money. You're not going to be able to make as much money if you're paying high expenses. In fact, if you minimize your fees, you're going to save years. In fact, maybe even be able to retire a decade earlier than you might have before. And here's an example. So let's say you have a 7% market return. Each dollar that you invest is going to increase to $30 over that next 50 years. Now, unfortunately, let's say we only have a 5% return because you have the 7% market return. Now we have to reduce it by some expensive mutual fees of 2%. Now you're only at that 5%. So instead of growing to $30, every dollar you're investing growing to $30, every dollar you're investing only increases to $10 over that same time period. So fees really do matter. And excessive fees, definitely, they can destroy your nest egg. In this situation, you can see that 2/3 of the value was thrown out the window. What are the fees? Well, you have to look at the small print. In fact, I don't like small print either, nor does John Bogle. And the other thing you may think about, well, what about active mutual funds? You often hear, do active mutual funds outperform over the long term? The answer is typically no. Active mutual funds significantly have very high bars to be able to jump over because they have higher fees, and so the amount that they need to essentially earn is even that much higher. So it becomes much more difficult for active fund managers to outperform over the long run. Certain years, guarantee. Certain years, they will do better. But then other years, they're not going to necessarily do better. In fact, finding an active managed fund that outperforms even after those expensive fees over the long run is like finding a unicorn. In fact, Samantha has this unicorn on her wall in her room, and while you can see Sammy loves unicorns, it's very rare that you actually see unicorns out in the wild. In fact, I'll tell you, this is the only unicorn I've ever seen, Shadow. So Shadow is the closest to the unicorn I have ever seen, and don't worry, no dogs were hurt in this process. Samantha did a Valentine's Day, a Valentine's Day photo shoot with our little dog, Shadow. And so this is Shadow dressed up as a mermaid unicorn. You can see the goggles there too. And bless. This is probably as close to the unicorn that you're ever going to see either. So back to cartoons, because I love cartoons. So here's an example talking about active management. I'm going to suggest a stock that you buy that has outperformed the market for the last 3 hours, right? That sounds pretty ludicrous. While trying to outperform the market over the long run, it's a loser's game. It really is a loser's game, and that goes on to our next biggest investment mistake, and that is that there's really no get rich quick. We know that successful investing, it takes time. You're never going to, double your market consistently, double your money in the market consistently over short periods of time. Even if you do find that perfect investment, Warren Buffett, who we all know is like the absolute god of investing, even he says that you may have some winners, but you're also going to have some losers. And the people who do best in the stock market are the people who have confidence, the people who have discipline, the people who have patience, and that are willing to stay invested over the long run. And the longer you're invested, the less of a chance you have of feeling any market declines. So that means that if you stay invested, that momentarily drop in the market is not going to have a significant impact on your portfolio for the long run. Really key and really important. So what does this mean? It means that to stay invested and to be able to turn off the CNBC, the CNN chatter that you see on the TV, the ups and downs, is to make sure that you have the right investment portfolio. That is really key. And having the right investment portfolio, it really comes down to what is the right engine. And you may be like this car here on the left, a Prius, based on your goals, based on how much you might have already have saved, and based on your tolerance of seeing your money go up and down in value. You might be a Prius. And that Prius means that you're going to have less in stocks, you're going to have more in bonds. Or you could be in this beautiful, beautiful Lamborghini. Now, the Lamborghini here is going to be mostly stocks in your portfolio. You may even have 80% of stocks of high engine souped up in your portfolio. But this isn't necessarily the right portfolio for everyone. Number one, because this is a portfolio where that Lamborghini, where you put your foot on the gas pedal and you kind of sit back and get thrown back against your chair, and then you put your brake on and you go flying forward. It's obviously, as you can imagine, a very different experience. So talking about Lamborghinis, this is my husband. And so Michael, I'll just give this as a side, kind of funny. So he would love a Lamborghini. So needless to say, his way of doing this was, you know what about the new Lamborghini SUV? Can you believe it? Yes, Lamborghini is putting an SUV on the market. And needless to say, he jumped in it, tried it out, did a little test. We went to the auto show here in New York. And, I explained to him that the engine in that Lamborghini, that we don't need it. In fact, our portfolio is 100% on track. We have a nice mix of stocks and a nice mix of bonds, and that we don't need to move to that 80% stocks because we're not behind. Now, if we were behind, we might have to do that. But I had to explain this to him. Now, knock on wood, he is not convinced. Bless him, he's comfortable. He's okay with the stock market roller coaster. He's okay with going again and again. But then again, I've been able to try and explain to him that may not be the best thing for our family. So he's continuing to hope for that Lamborghini SUV. I think he really, really wants the race car, but he figures the SUV has a better chance. But we'll just let him think that maybe someday, maybe, but until then, we're going to keep our current investment portfolio. We're not going to make any large withdrawals for Lamborghinis. And instead, the new car that we're looking at to lease is going to probably be a Honda CR-V, which is very, very good, middle of the road, safe, and has the type of engine that we need to be able to get where we need to go. All right, so we're going through a lot. Almost there. Pretty much our last investment mistake. This is the fifth investment mistake that I wanted to go over, and that is trying to do it alone. Trying to do it alone doesn't pay. In fact, you can see how the Standard & Poor's, S&P 500 did over the last 3, 5, 10, and 20 years. So this is on average, and you can see over the last 3 years that the S&P had a return of about almost 11%, 10.87% on average for the last 3 years. Now, the average investor return, look at that. The average investor return over those 3 years was significantly less. In fact, it was 3% less. It was closer to 7.63%. Why is it? Well, it's because individual investors often have a harder time of staying disciplined in bad times. Good times, no problem when they're earning lots of money, but it's in the bad times where individuals typically underperform. So let's talk about what does that really mean for your portfolio. So if you had an 8.21% return on $1 million, your portfolio over the next 20 years would grow to a little over $8 million. Now, let's assume that you were one of those individuals that got scared, maybe pulled some of their money into cash, maybe not fully invested in the market during that time. So instead, you got a little over 4% return. And over that same 20 years, your portfolio only grew to $3.9 million. So you can see it's a big impact. It's an opportunity cost of about $4 million. So what does this mean? Why work with an advisor? And Vanguard did a really nice study to talk about what is the actual financial benefit of working with an advisor. And on average, they said that working with an advisor reduces your expenses because they do the due diligence to make sure that the investments you have are the lowest cost possible. So essentially reducing the cost by 0.45%. Rebalancing the portfolio, making sure that as your investments over time, let's say your U.S. stocks grow more quickly than your bonds, bringing you back in balance to that ideal allocation. Studies have shown that that has a significant increase in your overall return, and it adds 0.35% to your overall return. And then asset allocation, so choosing the right mixture of stocks and bonds and making sure that you're staying in balance. And that actually, you can see, has a really nice impact of 0.75%. So we've talked about those areas. Now, some others, making sure that you're taking money for retirement from the right place and being smart with where those withdrawals are coming from. You can see that's a 0.7% increase. Behavioral coaching, this is where I think is the most powerful benefit of working with an advisor, making sure that you're staying disciplined, that you're looking long-term, that you're making the right decisions, and that has a 1.5% increase in your overall return over the long term. So the grand total of working with an advisor, according to Vanguard, increases your return by 3.75%. Which is a pretty big number. The challenge is what is the right financial advisor for you? It can be pretty tough. Is it any of these people, or is it one of these three people? And what we want to let you know is that 90% of these advisors here are actually really just brokers. In other words, they're paid to sell expensive financial products to you in return for a fee. Not ideal. And what are some of those products? Well, you can see that some of those products are annuities, mutual funds, whole life insurance, and these annuities that we mentioned are high commission. So what you want to do is you make sure that you're looking for what's called a fee-only financial advisor. According to Tony Robbins, he has written a really interesting book that talks a little bit about the different advisors out there. And according to Tony Robbins, of the 310 advisors that call themselves advisors right now, investment advisors, only 5,000 are actually independent fiduciaries and fee only. So what that translates to is almost 2%, not quite 2%, of the advisors out there are really able to work in your best interest. So what it means is that talk to your friends and family. Make sure you do research. In fact, many people spend more time planning their vacation than they do planning their finances and researching what advisor is best for them. And if you're interested in learning more about what we do, I wanted to just show you a little bit about what our second opinion service is. About 80% of individuals say, according to a Wall Street Journal article, that they would appreciate a second opinion on their finances. And so we look at their total investment portfolio, your money, where it is in your 401k, where it is in your IRA, and maybe even outside your IRA, even looking at your 529 plan education program, and give you really good ideas about the growth potential, about protecting the principal. We also look at how much cash is in there. So this person had quite a bit of cash. And also potential losses. So this person had significant holdings of bonds that were sensitive to interest rates. We also look at their portfolio versus what we would suggest and give them some ideas of what tweaks might you want to make between growth-oriented stocks like Facebook, Amazon, Google, and more value-oriented stocks such as General Electric. On top of that, we dive into the different types of industries that they are invested in and highlight those that they are either underinvested in or overexposed to. And even within the portfolio, making sure that they don't have all their eggs in one basket. And this person we saw had significantly underexposed to technology and consumer cyclicals, but also some Walgreens and Time Warner, essentially having too much exposure to those three companies. So one of the challenges we saw with this person is that throughout their whole portfolio, they only had about 18 stocks, which was a concern. That means that they're not really getting all the diversification that they would like. In fact, it was essentially putting all their eggs in one basket. And then finally, looking at the expenses. And what we saw is that they were essentially shredding and wasting money by paying high loads. So they were paying a load or a commission of 1% a year. And then they had an annuity, and in that annuity, they paid some very, very high expenses on an annual basis, as well as the year that they purchased it. So we take a look at that, and we also show some hypotheticals of maybe what their portfolio has done over time, what we might suggest, the difference in risk, and what it might be like for them long term. And why would you want to come to us? Well, we've got an award-winning team. We're part of the CNBC Advisor Council. We received the Women's Choice Award. We also have received many pro bono awards, as well as recognition for our services in wealth management and also in certain areas such as very complicated medical area. So please do reach out to us. We are here if you have any questions. You can see we have our email here, our website, and let us know. We are here to answer any information, any questions that you might have. Most importantly, if you know of someone that might like a second opinion, we would love to be there to support them and give them the peace of mind that they deserve. Thank you, Stacey Francis from Francis Financial. Have a great day.